Well, I am Jayendra Rana, and the topic for our discussion today is marine insurance market in India. Marine insurance market in India. Marine insurance is a type of insurance that provides coverage for ships, cargo, and other related assets that are involved in marine transportation. In India, marine insurance plays a crucial role in the country's economy as it supports the growth of the export and import industries. So let us have an overview of marine insurance market in India, including its history, type of insurance, key players, and challenges facing the market. So the history of marine insurance in India dates back to the 18th century, with the East India Company being one of the first companies to provide marine insurance coverage in the country. In the early days, marine insurance was mainly provided by foreign companies. But with the growth of the Indian economy, domestic insurance companies started entering the market. Today, the marine insurance market in India is well established and regulated by the Insurance Regulatory and Development Authority of India. There are several types of marine insurance available in India, including hull insurance, cargo insurance, liability insurance, and protection and indemnity insurance. Hull insurance covers the physical damage to a ship or vessel. Cargo insurance covers the loss or damage of goods during transit. And liability insurance covers third-party claims and protections, and indemnity insurance covers the legal liability of the ship owner. The Indian government also plays an important role in the marine insurance market through regulations and policies aimed at promoting the growth of the industry. So additionally, there are several reinsurance companies operating in India that provide support to primary insurance companies. But despite its growth and development, the Indian insurance market is facing several challenges. One of the main challenges is the limited domestic capacity of insurance companies, which makes it difficult for them to provide coverage for large and complex risks. Additionally, there is a lack of standardization in marine insurance policies, which can make it difficult for customers to understand and compare different options. And there is limited awareness and understanding of marine insurance among the general public, which can make it difficult to attract new customers. So the marine insurance market in India is an important and growing industry that supports the country's export and import industry. Despite the challenges facing the market, there are several domestic insurance companies and government regulations that support the growth of the industry, with an increasing focus on the maritime industry in India and the increasing demand for marine insurance. But it is expected that the market will continue to grow and develop in the future. So the India's economic growth is being significantly driven by digitization and technological advancements across all sectors, including insurance. So marine insurance is one of the oldest forms of insurance. It is also transforming customers' behavior, preferences, and demands, with Indian business increasingly expanding their global footprint. Marine insurance has become more essential than ever. The insurance industry in India is evolving to meet rising demand for digital accessibility, making it crucial to stay informed on the latest trends shaping marine insurance. Here are the key trends emerging in marine insurance, especially in the insurance industry. Growing emphasis on risk assessment and prevention is there. Conventional marine insurance policies focus mainly on compensation or compensating the loss to the insured. However, with advancements in data analytics and technological advancements like artificial intelligence, the Internet of Things and telematics, assessing the risk of real-time data has become easy. Hence, emphasis on risk assessment is growing in marine policy. The shift towards preventive measures by marine insurance companies in India not only aims to lower claim frequencies but also promotes a safer, more reliable environment for marine trade. Then risk-based pricing and rise in premium rates is there. So with increased shipping activity and higher exposure to risks such as geopolitical tensions and climate changes, premiums are likely to rise. Marine insurance companies in India are expected to adopt risk-based pricing more widely. Risk-based pricing more widely. So when risk-based pricing is practiced, the scope of coverage is personalized to the specific requirement of the insured party. Then growing demand for flexible and customizable policies. As risks are different for each nature of business, sectors like agriculture, pharmaceuticals, shipbuilders, electronics, etc. have their unique set of inherent risk along with regulatory requirements. So with the changing customer behavior and technological advancements, new risks are emerging, such as cyber threats. Hence, marine insurance companies are now offering flexible and customizable marine policies tailored to the needs of each business. And then automation and adoption of newer technologies. Most insurance companies are adopting new technologies like artificial intelligence and machine learning for claim processing, documentation, fraud detection, risk assessment, data processing, and analysis, underwriting, and more. The blockchain technology integration has enhanced transparency in the business process and security in policy and claims. The newer technologies are streamlining the process, enabling real-time data collection and risk analysis, improving transparency and introducing innovative marine insurance policies. So digital platforms also make it easier for customers to purchase and manage insurance online. Then green shipping incentives. Climate change is the most significant problem today, and every industry is trying to address this global concern. The companies are introducing eco-friendly policies in the shipping industry. This includes incentivizing businesses that implement energy-saving measures in their logistics and adopt new emission fuels. Some insurance companies may also offer discounts on the premium rates for companies that follow sustainable business practices. Focus on cybersecurity is there as shipping and logistic networks becomes increasingly digitalized. Cyber attacks have become a significant risk factor. Hence, addressing cybersecurity has become an integrated part of marine insurance coverage. International regulations like the IMO's guidelines on maritime cyber risk management emphasize the need for robust cybersecurity measures in the maritime sector. Marine insurance companies in India are also aligning their products with international guidelines to address customers' needs, helping shipping companies protect against attacks that could disrupt cargo movement or cause financial losses. The insurance industry in India, including the marine insurance sector, is set to witness dynamic growth in the coming years. New trends are emerging to address the evolving needs of customers, global trade, regulatory norms, and technological advancements. The trends in marine policy will shape the secure and sustainable insurance ecosystem for shipping businesses. Businesses that belong to difficult industries can have unique transport needs and risks. So flexible and customized marine insurance policies can be tailored to their unique insurance needs. Customers can avail the coverage that they need to be personalized to their nature of business within their affordable budget. Hence, commissions in the insurance sector is gaining popularity. Customization in the insurance sector is gaining popularity. India is aligning its regulatory framework with international standards to enhance protection for insured parties. The new regulations may focus on simplifying policies language, addressing emerging risks such as cyber threats and climate change, and ensuring transparency in the pricing and claims process. So, risk-based pricing helps insurance companies offer more personalized policies by assessing the risk accurately on real-time data and then adjusting premiums based on the specific risk profile and of the insured. This approach ensures that insured customers with lower risk, such as those using safer routes or sustainable practices, may benefit from lower premiums. Actually, this rate making in marine insurance has changed nowadays, because the fundamental principle of marine insurance are drawn from the Marine Insurance Act 1963. As in all contract of insurance on property, the contract of marine insurance is based on the fundamental principles of indemnity, insurable interest, utmost good faith, and proximate cost, subrogation, and contribution. So practitioners of marine insurance must familiarize themselves with the Act and uphold these principles when negotiating contracts and settling claims under the contract. The object of an insurance contract is to place the insured assured after a loss in the same relative financial position in which he would have stood had no loss occurred. So by the Marine Insurance Act, the indemnity that is provided is in manner and to the extent agreed. So commercial indemnity is thus provided because insurers cannot undertake to reinstate or replace cargo in the event of loss or damage. So they pay a sum of money agreed in advance that will provide reasonable compensation. In practice, this is achieved by agreeing in advance the insured value based on CIF value of the goods, to which it is customary to add an agreed 10%, which is intended to include the general overheads and perhaps a margin of profit on the transactions. So upon total loss of the entire cargo by an insured peril, the sum insured is paid in full. And a part of the cargo is total loss, the appropriate proportion of the insured value is paid. So claims for damages are settled by ascertaining the percentage of depreciation and applying this percentage to the insured value. The percentage of depreciation is calculated by comparing the value the goods would realize in their damaged state with their sum value on the date of the sale. So the same date is used for both values to avoid distortion of the result arising from fluctuations in the market prices. In marine insurance, it is customary to issue agreed value policies. The agreed value is conclusive between the insurer and the assured, except in the event of an unintentional error or where fraud is alleged. The duty and agreed value policies are not agreed value policies. They provide pure indemnity only. So insurable interest, the Marine Insurance Act contains a very clear definition of insurable interest. It states that there must be a physical object exposed to marine perils and that the insured must have some legal relationship to the object, in consequence of which they benefit by its preservation and is prejudiced by loss or damage happening to it, or where he may incur liability in respect thereof. Whereas in fire and accident insurance, an insurable interest must exist both at inception of the contract and at the time of loss. So the interest in respect of a marine contract must exist at the time of loss, though it may not have existed when the insurance was affected. So this is necessary when one considers the mercantile practice under which there is every possibility of sale and purchase of goods during transit. However, the MIA, that is Marine Insurance Act, has provided that where the goods are insured, lost or not lost, the assured may recover the loss, although he may not have acquired his interest until after the loss. So unless at the time of effecting insurance he was aware of the loss and the insurer was not. So if the assured had no interest at the time of loss, he cannot acquire interest by any act or election after he is aware of the loss arising from this. Both a contingent and a defeasible interest are insurable. So a partial interest is also insurable. Unless like the normal indemnity policy of other classes of insurance, a marine cargo policy is freely assignable either before or after loss, provided, of course, the assignee has acquired insurable interest. For the types of shell contract also determines the insurable interest. A separate chapter has been devoted to most common terms of the contract known as the INCO terms. So the terms dictate which of the two parties to the contract is responsible to insure the goods. To insure the goods. So under these circumstances, the type of contract responsibility for insurance are defined because the types of marine cargo insurance are specific: voyage policies, open cover, annual sales turnover policy and annual sales, duty insurance cargo imported in 20 years. Then the contingency insurance are there. Marine hull insurance is absolutely a separate wing or separate part. The type of marine hull insurance is rather bigger. Insurance of vessels and its equipments are included under hull insurance. There are several classifications of vessels, such as ocean steamers, sailing vessels, builders, cruise fleet policies, and so on. So it is concerned with the insurance of hull and machinery of ocean-going and other vessels like barges, tankers, fishing and sailing vessels. A recent development in hull insurance has been the growth of insurance of offshore oil gas exploration and production units, as well as connected construction costs. So it is covered with a specialized class of business, particularly for fishing vessels, travelers, dredgers, and land and sailing vessels are available. So the subject matter of hull insurance is the vessels or ship. There are many types of designs of ships. Most of them are constructed of steel, welded, and are capable of sailing on the sea in ballast with cargo. This is all about marine insurance. Thank you very much.